You've heard Warren Buffett say, buy the dip, but what does that actually mean? In short, it means to take advantage when the markets are down, but that's just the surface level.
There are other ways to make money moves while there's panic all around you, just like we are right now. So keep watching and we'll show you how to win in a bear market.
Bear markets can be scary when they're happening, but as an advisor for 20 years, I can tell you that they're a normal part of investing. Don't believe me? Let me show you some proof. So 94% of all years, the market experiences a 5% decline or worse. And 64% of the time, the market is down 10% or more every single year since 1928. 40% of the time, the market is down 15% or more. And 26% of the time, we see declines of 20% or more, which is a bear market. Since 1940, we've seen 32 corrections, somewhere between 10 and 20% pullbacks in the stock market. We've seen 7 of them that were 20 to 30% declines. We've seen 4 declines of 30 to 40%, and we've seen 3 declines of 40% or more. Again, volatility is very normal. It's just not fun. And what I want you to see here is every single year since 1979, you can see where the market ends up. And most years, the market ends up in positive territory. But somewhere throughout almost every year, we see a market decline of anywhere between 5 and 20% or more. Again, not fun, but very normal. And take a look at this. And this shows you that in most years, the US economy is in expansion mode. It's in growth mode, but it's punctuated every so often by these steep, sharp, scary declines. They don't last long, and they're always preceded by some really scary headlines, but at the same time, we get through it and we get back to expansion mode. But what should an investor do? Should you sell your investments and try to sidestep those steep declines? No, because here's why. This is a great study that shows, and there's tons of them out there, if you let your investments ride over long periods of time, you get great returns. But if you try to go to cash and you mistime it, and you miss the best day, the best 5 days, the best 15 days, your returns are literally slashed. Look at this. If you miss the best 25 days in a 30-year period, that's 1 day a year that you have a bad day, you get nervous, you sell, you get scared, you panic, your returns were cut in half. So you've just blown up a 30-year retirement that's been well planned, well saved for. If you get nervous and have 1 bad day a year, you're going to blow yourself up. So we would encourage you, do not sell and panic. But there's always a reason to panic. And take a look at this. And what do people do when they get nervous? They take money out of the stock market and it goes into the bond market because they get nervous and they don't know what to do. But there's always a reason to panic. Look at this, 1970s, we had the interest rates above 9%, we had stagflation, markets down 36%. We had the oil embargo, we had Watergate, markets down 48%. We had Black Monday, 1987, markets down 34% in that period. The dot-com bust, we had a 37 and a 34% decline there in a 3-year period. The great financial crisis of 07, 08, 09, markets down 57%. And most recently, we had the pandemic, markets down 34% in a month. So there's always a reason to get nervous. But why you shouldn't panic and sell and go to cash is found right here. This is one study of many where, if left to its own devices, the indexes and asset classes perform really well over time. And yet the average investor significantly underperforms the index because they get nervous and they sell at the wrong time, they mistime it, they go to cash. Instead of buying low and selling high, they buy high and they sell low. And you can see it across both stocks and bonds. The underperformance is really sickening and scary, and it's just because people get emotional with their money. So, still not convinced? Still think you can time it? Take a look at this. Watch how fast markets move. This is the sell-off when the tariffs were announced and the tariffs were going to be more significant than people thought. In a 2-day period, the market sold off 10%. And then when the tariffs were paused, the market shot up 9.5% in a single day. And watch how fast the market moved. Incredible. Information changes hands so rapidly today because of technology that there's literally no way that you can try and time the market. So don't even try. But there are some things you can do, and we're going to show you those right now. Some say the difference between winners and losers is how they respond to each twist of fate. Many people have won in down markets because they know what to do when they happen.
So let's tell you how to win, baby.
The first thing you can do is buy stocks at a discount. So if you have extra cash, go ahead and buy, baby, buy. But that doesn't give you permission to buy individual stocks at random. The smart move would be to buy index fund ETFs, as they give you broad market exposure to many companies all at once.
Right, and the stock market, like we've talked about before, is the only thing that we hear people running away from when we're seeing these big discounts of 20% down, 30% down. But think of it this way, one of my favorite stores is Viore right now, and if I saw a sign out there outside of the store, I'd be running in and buying everything because it's really expensive, and if there's a discount that's being provided, I mean, you're still getting that quality that's there, and the price will still come up eventually.
Right, the stock market's the only place that when great companies go on sale, people sell instead of buy. And we all know that we should buy low and sell high, but what the average investor does, they sell low and they buy high. The next thing you can do is do Roth conversions. So let me explain how a Roth conversion works. What you're going to do is you're going to convert money, take it out of your traditional IRA, and you're going to then convert it or put it into your Roth IRA. What that allows you to do is you will pay taxes on the conversion, and then by getting the funds in the Roth IRA, you get them invested, the recovery in the markets, which always tends to happen over time, the recovery will be in your tax-free bucket or your tax-free account, the Roth IRA. So when the markets are down, do the conversion now because you can convert more shares for less dollars. You'll have a lower tax bill by doing the conversion when the market's down.
Yeah, we've got a number of clients doing this thing exactly right now, where now they're being able to do bigger Roth conversions because the market's down. And moving it into that Roth, just like you said, is going to have a bigger recovery in that tax-free bucket to provide more tax-free dollars in retirement.
Right, and we love tax-free. Another way to win is tax loss harvesting.
Okay, so this one gets a little more complicated, and you can only do this in your non-retirement accounts or your non-qualified accounts. And so the idea behind this, just to make it simple, let's say that you own the Vanguard S&P 500, so VOO. When the markets are volatile and the markets are down, you'll want to sell out of this position, which sounds crazy because we always tell you don't sell when the markets are down, but this is what you're going to do. You want to replace that holding, so replace VOO with something very similar. It can't be the same, but something different enough, something like Vanguard's total stock market. So that's the total stock market from Vanguard. And so you replace that holding, and it allows you to realize those losses in the portfolio, but then eventually get to participate in the recovery with the VTI. And so you can do a couple of things with these losses. The first one is you can reduce your adjusted gross income each year if you're married filing jointly of $3,000. So that's some tax savings right there. And you can use these into perpetuity, so they don't expire. The next thing you can do is you can use those losses to offset some of your gains. So let's say you've got a vacation plan this next year and you want to take some of your gains off the table out of your non-qualified account. You can now realize some gains and offset those gains with those losses and maybe get some of those dollars back to you tax-free as well. So a very unique tool, and you just need to make sure that you're doing it correctly. So like I said, if you want to talk about how this can work in your portfolio, give us a call because it can get messy and cause unnecessary taxes.
Right, Matt touched on something that's really important. You cannot replace the security that you sold with the same thing because you'll violate the wash sale rules. So to his point, it does get tricky, it gets complex. Contact your financial advisor, contact your CPA, or just give us a call and we'll walk you through it and show you how to do it correctly. But it's a great way to save money on taxes. And finally, we have rebalancing. So you should own somewhere between 7 to 10 positions in your portfolio, and you're gonna buy low and sell high. So what happens is all of those different asset classes in your portfolio, they're not all doing the same thing at the same time. For example, the bonds right now in everybody's portfolio are up. If you've owned the correct bonds, your bonds are actually in positive territory. This is going to present you an opportunity to sell high. You're going to trim, not all of it. You're just going to trim and bring the bonds back to the allocation that you should have in your portfolio. But then you're going to look for opportunity on the stock side. What's down the most? Right now, US small cap is down the most, followed by the S&P 500. You're going to start to see buying opportunities in those asset classes. And by rebalancing through markets and not trying to time them or managing two markets, you're going to have much more success.
Yeah, and then by having that diversified portfolio, if you're in distribution mode, it gives you that flexibility to target the area of your portfolio to continue to do those distributions. And maybe you're not necessarily having to sell when the assets are down, or not having to sell out of the worst ones, and so keeping your portfolio working for you too.
Bear markets are scary, but they don't have to be. We see a lot of things going on in the markets right now because of the tariffs. Markets are moving every which way, every single day, and they're moving fast. It feels like there's a lot of uncertainty, and we really don't know how the tariff situation is going to unfold. So if you want a partner and a guide on your journey, if you want someone to help you with strategy to help you thrive in a bear market, feel free to reach out to us. We're happy to help you.
And if you like content like this, be sure to like and subscribe, and we'll see you on the next one.